Hi everybody, it's Tuesday and we're on the floor of the New York Stock Exchange with Jim Cramer to break down today's market action. All right, Jim, we are trying to add to yesterday's rally. What do you think?
Well, I think it's going to be difficult because you have a lot of things that are away from tech that are just okay. You got a split retail market, and we can talk about Kohl's. You have this very jarring tolls number, which is saying that housing is weaker than we think. So you have a kind of a mortgage situation brewing that people don't like. You've got some of the oils up, some of the oils down. The industrials made their move yesterday. People are viewing Micron as zero sum. If it's good for Micron, it's bad for NVIDIA. The Micron semiconductor equipment companies are doing better. But, you know, I think you got to be careful. You're up 300. It would be natural to have some profit taking.
Although, as you read in Real Money, we know that the Schlumberger CEO has told us about the rise in oil prices.
He predicted it, and I think that what you have to recognize is that Schlumberger was saying everything that happened, and what's surprising, although there's an article in the Journal about spending in Latin America, what's surprising is that typically the oil companies, both of the national kind, the country, and the corporate, would have dramatically really pumped out the dollars, increased the spend, and it hasn't happened. And that's somewhat surprising. And that's what makes it so that you may think that when oil comes in, you have to buy oil. Now remember, I distinguish between oil and natural gas. There's too much natural gas. But I do recommend if oil comes in, or if oil stocks come in, or if oil services come in, that you buy, because there's no pickup to the point where we can expect that the supply demand is going to come back into balance. Right now, the demand is higher than the supply.
And for a long time, you felt that Schlumberger's conference calls give a good indicator of where oil is going.
And what I did was to look back and see what he said last time. And Kibsgaard, he kind of really nailed it. And he really predicted everything. In the end of the year last year, he predicted that 2018 would be the year of the turn. It's very clear now that that the companies didn't spend and the countries didn't spend, and that's why we're tight. And he predicted that Iran would be difficult. He predicted that Venezuela would be in free fall. Venezuela's now down to 1.4 million barrels a day, and Venezuela is the world's largest reserves. So these are all things that occurred. They were predictable, except for the fact that there was not no increase in spend to speak of. So I mean, that's why, for instance, you look at Exxon. And you'd say, well, wait a second, Exxon, the Journal says that they're increasing their spend in Latin America. But why is Exxon stock flat? With oil up, they didn't decide to turn the jets on. They should be drilling all over the place. And China didn't drill. China's become, obviously when we talked about trade yesterday, we're talking about sending our oil to China. We do not have enough oil to make it so that it can go to China right now. And also, Kibsgaard was saying that we are drilling so many holes that we're already hurting our production. So he's not a bull on U.S. by any means.
And if we see sanctions with Iran, who knows what that could mean for the oil market. All right, go to realmoney.com for more on Jim's oil outlook. Jim, let's also talk about GE. Steve Tusa sticking with his $11 price target.
Yeah, and you know what? I think that I was talking to David. I mean, here's what I would have done if I were Tusa, and I didn't say this on air. I'm glad you asked me, because I'm not, these good things we didn't cover on air. That's very good. GE hit 12, and Steve Tusa predicted in the high 20s that this thing was going to go low. And I feel when you have an analyst who's been that right, why not go from sell to hold? It's not saying buy it, but you want to not lose the idea that you stuck with the sale. Now, we had the Wabtec deal, which gives us some optionality to GE. Did they take in enough money? Well, sure, everyone wishes they would take in more money. Are they disposing assets fast enough? Well, everyone wishes they dispose assets faster. But the point is that TUS is saying they have to do some sort of a change of capital, which I read as being that they have to do some sort of fundraise, maybe a gigantic offering, excuse me, and that a dividend cut could be again in the cards. I don't know. I just think you should have just gone to hold.
And how much the rise in oil prices, which we just talked about, has helped GE.
Yeah, it's helped GE. GE's an oil company. It's an energy company, and it needs higher energy. Obviously, the aerospace engines are more fuel efficient. I would tell you not as fuel efficient as the Pratt & Whitney engine, But I do think that GE is a big beneficiary of oil, and he's not including enough of that in his research.
Okay, we'll watch how that plays out. GE shares are at about $15 a share. Jim, you had the CEO of Zillow on last night. He's now getting into this buying and selling of home business.
Right. This is something that I questioned him. He said, look, do you question that Netflix started making its own movies, own programming? They knew what people wanted. They had the artificial intelligence. He said, why not? And we understand what people want. We understand what people want to buy. We can turn around these homes very, very quickly. And that it's just a natural extension of business for them. I obviously liked and have liked for a long time, their asset-light business, this great advertising business they have on Street Easy, on Trulia, and on just plain old Zillow. And this is deviating from it. It's riskier. I think that Spencer would he would admit that it's riskier, but he does have a better handle on it than almost any other company, maybe any other company in the country.
And I'm looking here, mortgage rates at a 7-year high.
Right, so. And that's Toll Brothers. And Toll Brothers is, when you read the quarter, you think it's very good, but it's not good enough. And there's a grudging understanding that it's not good enough. They actually missed the estimate simply because, let's just face it, rates are higher, and the mortgage market is, when the rates are really, really low, you're going to sell more homes. That doesn't mean that they won't sell a lot of homes. It does mean that the expectations were set at a time when rates were lower, and the expectations are harder to meet.
Jim, you have quite a lineup on Mad Money tonight.
Yeah, I've got, first of all, Rent the Runway, private company, part of CNBC's Disruptors. Very, very good story. Everyone on my Mad Money staff uses Rent the Runway. Union Pacific, which I think is a remarkable story. They are doing so much right. And a lot of different cargoes that are good. Remember, when you hear freight on these conference calls, they're a winner. And then Micron, which is the biggest winner now for 2 days in a row. And that's because Micron has turned into a secular growth story, not a cyclical story. Rather amazing. I cannot wait to speak to that company.
All right, we'll be watching tonight, 6 p.m. Eastern on CNBC. Meanwhile, Jim, we'll keep talking about stocks on our Action Alerts Plus.
I want to urge people, those who are watching this free, and I know a lot of you watch it free, we do our own program for our Action Alert stocks, and I think you should trial Action Alerts. I just get very good feedback, and I think that this is a fun program, the free program, but I think that if you do Action Alerts, you would appreciate all of the coverage that we give you, both good and bad, okay? When we screw up, we own it, and when we do it well, we don't just pound our chest, but we say, here's what is the reason why they're going up.
And we're now taking member questions on the video.
Right, and that's a new change.
All right. Jim, thanks very much.